What if I told you that I took $500, split it evenly across 5 popular dividend ETFs, and just let it sit for an entire year? No panic selling, no rebalancing, just $500, 5 funds, and 12 months of watching dividends roll in. Today I'm going to show you exactly what happened, the good, the bad, and the surprisingly interesting. Welcome back to the channel. If you're new here, we talk about personal finance, investing strategies, and building wealth the smart way. I'm your host, and today's video is a deep dive into dividend ETF investing. Specifically, what actually happens when you put real money in and leave it alone for a full year. So let's get into it. Before I reveal the results, I want to talk about why I chose dividend ETFs in the first place. If you're newer to investing, a dividend ETF is essentially a basket of stocks that pay regular dividends, meaning companies share a portion of their profits directly with shareholders. When you bundle dozens or even hundreds of these companies into a single fund, you get diversification plus passive income. It's one of the most beginner-friendly ways to start generating cash flow from your investments. Now, the appeal here is simple. You invest your money, and over time, that money pays you back, without you having to sell a single share. That's the magic of dividend investing. And ETFs make it even easier because you don't have to pick individual stocks. The fund does the heavy lifting for you. But here's the question I kept asking myself. Are all dividend ETFs created equal? Because there are dozens of them out there, each with different strategies, different yields, and different risk profiles. So instead of just picking one and hoping for the best, I decided to invest $100 into 5 different ones and track them side by side for 12 months. Here are the 5 ETFs I chose for this experiment. Number 1, VYM, the Vanguard High Dividend Yield ETF. This is one of the most well-known and widely held dividend ETFs in the world. It focuses on large-cap U.S. companies with above-average dividend yields. Think stable, blue-chip companies with a long history of paying dividends. VIM is the kind of fund your grandfather might have held. It's boring, in the best possible way. Number 2, SCHD, the Schwab U.S. Dividend Equity ETF. If you spend any time in personal finance communities online, you've heard of SCHD. It has a massive following, and for good reason. It screens for dividend quality, not just yield, meaning it looks for companies that can sustain and grow their dividends over time. It's become something of a cult favorite among long-term dividend investors. Number 3, JEPI, the JP Morgan Equity Premium Income ETF. This one is a little different. JEPI uses a covered call strategy on top of its equity holdings to generate additional income. The result? A much higher monthly yield compared to traditional dividend ETFs. But there's a trade-off, as we'll see when we look at the numbers. Number 4, RYLD, the Global X Russell 2000 Covered Call ETF. Similar in concept to JEPI, RYLD uses covered calls but on small-cap stocks tracked by the Russell 2000 Index. It offers one of the highest yields you'll find among mainstream ETFs, but it comes with its own set of characteristics that you need to understand before diving in. And number 5, QYLD, the Global X NASDAQ 100 Covered Call ETF. QYLD is probably the most controversial pick on this list. It consistently offers a double-digit yield, which sounds incredible on paper. But as with anything in investing, if something looks too good to be true, it's worth looking a little closer. So those are our 5 contestants. Each got exactly $100 on day 1. Now let's talk about what happened. Going into month 1, I wasn't expecting fireworks. Dividend investing is a long game. Everyone says that. But I was curious how quickly I'd start seeing actual dividend payments hit my account. The answer? Faster than I expected. Both JEPI and QYLD pay dividends monthly, so within 30 days of investing, I was already seeing small deposits. YL also pays monthly. VYM and SCHD pay quarterly, so I had to wait a bit longer for those, but the anticipation was part of the experience. By the end of month 3, I'd received my first round of quarterly dividends from VYM and SCHD, and multiple monthly payments from the covered call ETFs. The total dividends received in the first quarter? Not life-changing money. We're talking single dollars here. But remember, this is only $100 per fund. The percentages matter more than the raw dollar amounts at this scale. Heading into months 4 through 6, things started to get more interesting. The market had some volatility during this stretch, and that's where the differences between these ETFs really started to show up. VYM and SCHD held up relatively well during the market turbulence. Their focus on quality dividend-paying companies provided some cushion. SCHD in particular showed why it has such a loyal following. Even during a rough patch, the underlying companies continued paying their dividends without cuts. JEPI was also fairly resilient. The covered call strategy actually benefits in certain market conditions, specifically sideways or slightly down markets, because the premiums collected from selling call options provide income even when stock prices aren't rising. I found this really interesting to watch in real time. RYLD and QYLD, on the other hand, showed more price sensitivity. The small cap exposure in YLD means it tends to move more dramatically with market sentiment. And QYLD, tracking the NASDAQ 100, can be volatile given the tech-heavy nature of that index. Their high yields were doing their job, providing income, but the underlying share prices were telling a different story. Months 7 through 9 brought a new consideration into the picture: dividend reinvestment. Because I was treating this as a long-term experiment, I made the decision to reinvest all dividends I received back into the same fund that paid them. This is the power of compounding that everyone talks about. What I noticed is that even at small amounts, reinvestment starts to create a snowball effect. Each time I received a dividend payment and used it to buy fractional shares, the next dividend payment was slightly larger. It's subtle at first, almost imperceptible, but the math is undeniable. Over decades, this compounding effect is what turns modest investments into significant wealth. SCHD really shone during this period. Its dividend growth track record means that not only were the dividends being reinvested, but the underlying yield on cost was improving. This is a key concept. As a company grows its dividend over time, your original investment effectively earns a higher and higher yield. SCHD has consistently delivered dividend growth year over year, which is why so many long-term investors swear by it. The final quarter, months 10 through 12, brought the home stretch. By this point, each of the 5 ETFs had established clear patterns, and I had a much better sense of what each one was actually doing for my portfolio. VYM continued its steady, reliable performance. No surprises, no dramatic swings, just consistent dividends from a diversified basket of quality companies. Exactly what you'd expect from Vanguard. SCHD remained my personal favorite from a total return perspective. The combination of dividend income and share price appreciation made it the standout performer when you looked at the complete picture. JEPI delivered impressive monthly income throughout the year. The yield was notably higher than VYM or SCHD, and the monthly payment schedule was genuinely satisfying. However, the trade-off became clear. Because of the covered call strategy, JEPI doesn't fully participate in strong bull market rallies. You're essentially capping your upside in exchange for higher income. RYLD was the wild card. The yield was high, very high, but the share price erosion over the course of the year was noticeable. This is called yield trap territory, and it's something dividend investors need to be aware of. A 10% yield means nothing if the share price drops 10%. And QYLD, controversial for a reason. The yield is eye-catching, but the total return picture tells a more sobering story. If you're relying on QYLD for income in retirement and not reinvesting, it could work as part of a diversified strategy. But as a growth vehicle, it struggles. Now for the moment you've been waiting for, the year-end results. After 12 months of investing $100 in each ETF and reinvesting all dividends received, here's how each fund performed in total return, meaning share price change plus dividends received. VYM came in with a solid, respectable total return. Nothing flashy but dependable, the kind of fund you can hold for 30 years without losing sleep. SCHD was the top performer in total return for the year among our 5. The combination of share price appreciation and dividend income resulted in the strongest overall result. Its quality screening process clearly worked. JEPI came in strong from an income perspective, the highest actual cash dividends received over the year, but when you factored in the share price performance, its total return trailed SCHD. RYLD and QYLD brought in the highest dividend yields, but suffered on the total return side. The income was real, but it was partially offset by share price depreciation over the year. So what are the lessons from this 12-month experiment? Lesson 1. Yield is not the same as return. The funds with the highest advertised yields, QYLD and RYLD, were not the best performers on a total return basis. Always look at the complete picture. Lesson 2. Dividend growth matters. SCHD's focus on companies with growing dividends paid off both in terms of income and share price appreciation. A 5% yield that grows every year is more powerful than a 10% yield that stays flat or shrinks. Lesson 3. Covered call ETFs serve a specific purpose. JEPI, RYLD, and Q are not designed to maximize total return. They're designed to maximize income. If you're in retirement and need monthly cash flow, they might make sense. If you're still in the accumulation phase, traditional dividend growth ETFs may serve you better. Lesson 4. Boring wins. VYM and SCHD are not exciting. They don't have the eye-popping yields that make great YouTube thumbnails, but they delivered consistent, dependable results. In investing, boring is often beautiful. Lesson 5. Start small, but start. Even at just $100 per fund, this experiment generated real dividends, real compounding, and real insights. Imagine what those same dynamics look like at $10,000 or $100,000. If I were to do this experiment again, I'd probably allocate more heavily toward SCHD and VYM, use JEPI as an income booster rather than a core holding, and skip QYLD and RYLD unless I had a very specific income need they could address. The bottom line? Dividend ETF investing works, but the details matter enormously. Not all dividend ETFs are created equal, and understanding what's under the hood of each fund is the difference between building wealth and spinning your wheels. If you found this video helpful, please give it a thumbs up. It genuinely helps this channel grow and allows me to keep making content like this for free. Drop a comment below letting me know which of these 5 ETFs you'd pick, or if you've had experience with any of them yourself. And if you want to see more experiments like this, different asset classes, different time frames, different amounts, subscribe and hit the bell so you don't miss anything. We've got a lot more coming. Until next time, keep investing, keep learning, and keep building toward the life you want. I'll see you in the next one.